All right. So
Uh,
before this guy comes on, who is he? He's a
yeah.
financial analyst.
So he's my financial advisor. So he's a financial advisor, but he does work with healthcare providers and just doctors. And yeah, so I just like really want people to know what they could be doing. I worked after college and I could have done a Roth IRA then, like, and I'm not no blame or anything, but like it would have been nice if I knew this information. And so I hope people listening can.
Well, in order to have a Roth IRA that makes sense, you have to have income that you can then put a portion of it into a Roth IRA. You didn't
So
have
when
any
I was,
income
no,
for
I did
quite
when I
some
was
time.
tutoring.
Yeah,
I
but
mean,
did you want to save that money at that time, or did you want
I
to?
put it into my life savings, yeah, into my
Oh,
investment accounts.
I didn't know that.
I did because you guys were paying for everything.
What a scam artist. That's that's
Um,
something you could do a podcast on, how to scam your parents, like all the little angles that I used to
no offense, Dad.
sneak
It wasn't,
vodka, the house, and all that kind of stuff.
no offense, it wasn't that difficult. I would just, I actually, for the
Low
sneaking,
hanging fruit.
low hanging fruit, for the people that like are curious how I would sneak vodka out, it was opening the liquor cabinet,
And
pouring
taking
it
the
into the
vodka,
water bottle, and then taking it, yeah,
uh,
and leaving just at this amount.
a
I
complex scheme.
exactly right. It was really, you were at work. I chose liquors that I didn't notice you drinking.
It probably was spoiled because it had been sitting for years, I'm guessing.
All right, so maybe for the parents listening, like don't let your kids drink your spoiled alcohol. You should have known better.
Right. Good tip. Good parenting tip from
Yeah.
Kylie. So like your list of top five ways to scam your parents, what are the others?
Well, I'm only going to tell you the ones I don't do anymore, but
There's nothing worse than when it's happening and you don't even know it, you know?
right,
That's
right under
that's
your nose,
really
right under your nose. Um, so that's for another episode. Maybe after this episode with Dan and I start making money, I won't need to scam you guys as often. So, a little bit about our guest today. We're having on Dan Hochler of Forest Hills Financial Group, which is a privately held financial planning firm. He has worked with several different professionals, but specifically works with a lot of medical professionals for the last 12 years in all aspects of their personal and business planning. Like I mentioned, he's my financial planner, and it was just so comforting to have someone who's been there, done that with our type of people. So he knew more than I knew about what kind of malpractice insurance I need, what the different types are, the benefits, all this kind of stuff that I would have just been like, that one's the cheapest option and I don't feel like dealing this. I have other things to deal with. I don't have to deal with it. It's all him, and it's such a great feeling. And he's a good guy, and I really trust him. The other thing is that my dad is also very financially savvy, so I was a true medical moron in this episode where I asked all the dumb questions. It wasn't like my best look, but hopefully will help people who also feel the same way I do about finances get their questions answered that they're too scared to ask. So here are our thoughts, and then we'll get into the episode real soon. Hope you enjoy.
First of all, I think we should have a disclaimer that we do not provide investment or financial planning
Mhm.
advice. This was just a conversation. People want to pursue getting guidance on their finances. They should contact licensed professionals.
Can that be the disclaimer? Do I have to do
Yeah,
something
no,
else?
that's
Okay.
that's fine. I think that there's a lot of good tips there that Dan started with for people who are starting out and don't really know much about their finances and such. I think it's a complicated topic, and I think his point that most, if not all people, especially at the beginning, need professional guidance. It doesn't mean they have to have it for their lifetime. I mean, some people get to the point where they're confident in their ability to make their own financial decisions because they've absorbed the inputs from the trained professionals. But I think when you're first starting out, you should consult with somebody who you feel is well credentialed and trustworthy. You should do your diligence on them, because there are stories about people who do scam. And so you want somebody who has your best interests at heart and is properly insured and, works at a reputable firm, or, you can even go on, I think, on the SEC, the Securities Exchange Commission website for registered investment advisors and see if they've gotten any kinds of investigations against them,
Oh, that's a good tip.
sanctions, things like that. I think also what I was always taught as a young lawyer was the KISS theory, which is keep it simple, stupid. And I would apply that here. There's so many things to kind of think about. Just start out with focusing on a couple of key starting points, and then over time you can kind of expand that into more and more stuff. But the things you need at the beginning of your career, you need malpractice insurance, you need disability insurance. If you're not working for an employer who provides health care, you have to get your own health care insurance. And then what to do with what kind of a savings plan do you put in place? I mean, having some level of financial discipline, looking at your what money is coming in every month and looking at your expenses, rent, food, and then discretionary, and then, putting some of that money into, as he was saying, short or midterm savings bucket, I think is a good way to look at it. And then over time, you're going to develop goals and objectives. Do I want to buy a house? Do I want to have investment property that I manage and that generates income for me? Things like that, I think over time you grow into, but those are kind of some of the sort of starting points that I think make a lot of sense.
That's a really, really helpful overview. And we get into all those topics in the episode. Also, as I'm listening to you say all these things, like I've gotten better over the years, but I feel my heart rate increasing. Like this is an anxiety provoking topic. And what I liked about talking to Dan, and he likes to goof and stuff. So I enjoy that because it makes the conversations lighter. But we're really just scratching the surface. And it's worth the slight amount of anxiety of having these conversations. I could see people being like, I don't want to think about that right now. Like, I don't even have any money. I don't have anything. But it's like, you just got to get over the hump and start learning about this stuff as soon as possible so that it's not this like, okay, I have to get a financial advisor. This is really stressful. So I think this is like a really good starting point for a lot of people too. And I learned a lot too.
And I think just to people who are saying, I don't have any money, I'm not ready for this. And people like him are smartly willing to invest in time spent with you at the beginning of your career under the thinking that ultimately you will build your career and you will have excess income for investment and to buy these, insurance products and things like that. And so, you shouldn't feel like, he's going to look at you like you have nothing to offer. He's making an investment in a future relationship, and that's what's in it for him. So people who are starting out should not be hesitant or reluctant because they feel like they have nothing to bring to the table as part of the relationship. I think that's important to know.
Right. And I feel very comfortable that I have like someone else looking at my finances, that if I miss something, I feel safer that he's around. So let's welcome financial advisor Dan Hochler to Medical Morons. I'm excited about this because you're my financial advisor, and I do ask a lot of questions to you, but I can like guilt free and feel like I'm not like harassing you ask all these questions. So it's a win for me as well. But just for anyone who's listening who's not in the medical fields, like I'm about to be like a super moron in this episode because I really don't know shit about finances, and I feel like most of my peers don't either. But if you're like in business or tech or finance or whatever, like either turn this off or like no judgment of the questions that are about to come out, because we're really going to get to like the elementary basic level of things.
So somebody coming out of a medical or dental residency program who's about to start their career contacts you. What's the process that you begin with? How do you get launched with a client who's coming out of that kind of a scenario?
Sure. So it's like going to see a doctor, right? Wait in the waiting room, and then the doctor doesn't come in and say, okay, I'm prescribing this, or we need to do this procedure. I need to do an analysis. I need to do a checkup, right? So initially it's a fact find. Who does your malpractice insurance? Who does your umbrella coverage? What type of disability insurance do you have? How much do you have in savings? How much do you have in student loans, mortgage, private loans? And then essentially, what are we trying to accomplish personally and professionally the next 3-5 years? For the first call, I do a little homework for them. I come back. We talk about protection first, right? You're going to LBI after this call, right? Are you driving? You're taking a bus, you said?
I'm taking the bus.
Okay. Have you ever driven a car before?
I sure have.
So let's say you were driving to LBI, right?
Okay.
And you get to town and you're listening to the radio, your favorite song is on, and God forbid you rear end the person in front of you, right? And all of a sudden their neck hurts really bad, right? And they find out, you're an ortho. What are they or their family going to do?
They're gonna sue me.
Yeah, and how much are they going to sue you for?
More than I have.
Yeah, as much as they can get, right? So if you're not protected from someone suing you, who cares what the rate of return is in your investment or retirement account? It doesn't matter, right? So we want to protect first. Lawsuit, sickness, injury, disability, premature death, right? We want to make sure you have the appropriate legal documents in place, et cetera.
It's really helpful talking to someone like you about all of this like early on, because I remember thinking like, obviously I need malpractice and disability insurance and all those things, but I was kind of like, okay, I'll deal with that later. Like, let me, I was kind of like, I need a job. I need to like, I just graduated. I was kind of like, all right, why are we rushing to this? And then once you explain it like that, I'm like, okay, I want it yesterday. I need to make sure nothing like that ever happens to me. One other thing before we kind of get into the other nitty gritty. I asked you this, not because I doubted anything of you, but I think people in the medical field we're like nervous we're being taken advantage of because we are easily taken advantage of and we don't know what the hell is going on in anything except like teeth or whatever profession you're in. I asked you how you make money. I think people are like, why don't I just make a list of all my insurances and do this all myself and I'll just put it into the S&P 500 and I'll be just fine. So how you make money off of us, and then also why that's worth investing in you guys versus someone who's very organized and wants to make a spreadsheet and do this all by themselves.
So you can do it all by yourself, right? Let's talk about the first thing, the insurance first. Medical professionals in general, you guys and gals get hit over the head about buying disability insurance every year, PGY1s all the way through fellowship, et cetera. We all on the insurance side, we all sell the same stuff, right? All the same policies. It doesn't cost more or less to get it from me than it does anybody else. If you called Mass Mutual, 1-800 Mass Mutual, whatever their phone number is, or you called me, or you called the guy I got down the street, whatever the policy is, it's going to cost the exact same. Why would you do it on your own and get a stranger, that Mass Mutual is going to give you anyway on the phone versus someone who's been in the business 12 years, has hundreds of clients in medicine? Why not get the free help? The cost of the coverage, my commission or any insurance person's commission is baked into the cost of the product, right? People, to your point, fear like, how much is this person making off of me, right? It's very easy in my business to oversell or recommend things that are not appropriate for the client. But what's going to happen very quickly, I might make more money today recommending something that is inappropriate, but how many introductions and referrals am I going to get from that client in 6 months, a year, 3 years, 5 years? So I took the very long career path. I started when I was 25. I made no money for several years.
I was thinking that because I was like, I'm sorry, Dan, I feel like you're losing working with me because I don't have any money. And like, you're not going to be making much off of me for a long time, but you're in it for the long haul.
Yeah. And getting back to like, it takes a village. Like I leaned on and asked for help from so many people in my business early on, and they kept encouraging me. And fortunately, I listened, but it took several years. But I'm in this for the long term. It's a long-term play for me, and it's a long-term play for my clients. With my partners on the wealth management side, it's similar to anywhere else you could invest the money. You go to a Goldman Sachs or any type of investment brokerage, the fee is going to be 1%, 1.2%, 80 basis points, right? There's nothing really, getting back to we all sell the same stuff. There's nothing proprietary. It's not the Forest Hills Financial Group fund or anything like that. It's all money managers you've heard of. The best way to make money for me is introductions and referrals to colleagues, family, friends, because that's how I built my business.
Keep going on the thread of, what are the key things for somebody in Kylie's situation to be focused on? So you highlighted protection as sort of number one. What are the other kind of pillars that you build off of when you're beginning with somebody who's emerging from a residency program?
Sure. So what type of doc are you going to be, right? Are you entrepreneurial and do you want to open your own practice? Is there going to be a succession plan from an older doc and you want to buy them out, right? How are you going to attract and retain new employees, right? What's the exit strategy? Who are the people helping you with this? What type of marketing are you doing? What type of industry events are you going to? I kind of want to be coaching them. Look, if this is what you want to do, this is where you need to go. This is who you need to meet. I can introduce you to an accountant who works specifically with dentists. I can introduce you to an attorney who works with specifically dentists. You need to have a team around you that can cover all your bases. I think what's most important is they all need to be talking to each other, right? That's what I find is a big problem, because we fast forward 30 years later, the accountant doesn't know the attorney doesn't know the financial advisor, the insurance person doesn't know the accountant. You need to build your team early on, and you need to find people who advocate for you versus, getting back to your earlier question, doing it all on your own. Yeah, you can put your money in index funds and you'll probably be okay. But like, you work I don't know if I can curse on this podcast, right?
Yeah, go for it.
You worked your ass off, right? You did so many years of training, right? You took out hundreds of thousands of dollars of student loans, right? Do you want to be like, no disrespect to someone making 40, 50,000 a year, but like, should you be doing the same financial things and following the same principles as a rank and file employee, who didn't work their butt off and take out all these loans? There's not one thing is best for everybody, or everyone should be doing X and Y and Z.
I think somebody in Kylie's position, the best luxury that they have in terms of their financial picture and planning for their future is longevity, hopefully, is time, right? I mean, somebody can start putting money away in their late 20s, early 30s, as opposed to somebody who comes to you in their mid 40s. I mean, that's a huge advantage from the standpoint of having money being put to work over a longer period of time. So when you're talking to somebody like Kylie, what's the perspective? What are you trying to get their frame of mind to as they look at their financial future?
Yeah. So pay yourself first. Early savers always beat late savers, just to what you said, Michael, right? Someone like you, Kylie, access to capital and liquidity. And when I say someone like you, I mean, more often than not, someone who's bigger than just, I'm going to work for someone for 40 years. I don't see that. But really, for you or a lot of people in your position, you're going to get hit over the head, and you should be, put money in my retirement account, right? So what are the chances you're going to retire next year, Kylie?
Unfortunately, not.
Right. So you're locking up money for 30 plus years. And by the way, you should be putting money in a retirement account, right? But a lot of people I meet, they're 45, they're 50, and 90% of their net worth is in their retirement account. And that's great, by the way, because it's money they were never able to touch. It comes out of their paycheck before they can touch it, and they don't think about it. And they look and they go, great, I have $2 million. But then I explain to them, you don't have $2 million. And they go, what do you mean? I sent you my statement. There's $2.1 million in here. I said, yeah, but you haven't paid taxes on that. So that $2 million is really $1.2 million, right? And $2 million sounds like a lot of money, but you're in New York or New Jersey or anywhere that a bagel and a coffee is $12, right? $2 million that hasn't been taxed yet, that's supposed to last them for 30, 40, 50 years. There's no way. So you should be saving into a short-term bucket. That could be savings, money market, brokerage account, under your mattress, just money that you can pick up the phone or go down to the bank or go under your mattress and it's there, right? You've already paid the taxes on it. It's accessible. Then you have midterm money. So maybe 5, 10, 15-year window. Oh, I want to buy a property. I want to buy an investment property, or I want to buy a home, right? And then long-term. So depending on who I'm talking to, how much should be going in short term, how much should be going in the midterm, and how much should be going in the long term.
Somebody who's in a situation like a resident who borrowed to pay for their education, what do you tell them in terms of money allocated to investment versus money allocated to paying down the debt? And how do they figure out that split?
Yeah, absolutely. So our firm has proprietary software. When we say, okay, you owe this amount, this is what the minimum payment is. It's supposed to be paid off in 25 years. This is the fixed rate. This is the minimum payment. 25 years from now, this is what it looks like. Money's emotional for most people. So I have people who are so adamant, I want to pay it off. I want to pay it off quickly. I want to get rid of the debt. And that's not wrong. It's just, what type of outcome should I expect in scenario A, where I pay the minimum, and scenario B, where I pay it off really quickly, right? So we're in a, unfortunately, relatively high interest rate environment now, but people are refinancing a 25-year at 5.4%. Considering where we are, it's not so bad. If you look at historically investment or returns, they're greater than 5.4%, right? So in 10 years from now, person A still has 100,000 of debt, let's say, and person B paid it all off. However, that's great, you paid it all off, but your net worth is the same. Person A and person B, the net worth is the same, except Person A who didn't pay it off has more optionality because they have X amount, $100,000, let's say, in their savings or investment account, versus person B who paid off more aggressively has nothing in their saving or investment account. Right? So who has more options? If the net worth is the same for person A and person B, but one has 100 grand in their pocket, one has 0 grand in their pocket, who would you rather be? So the person who's paying the minimum, they might get a raise, they might get a bonus, their practice might be exploding. One time during that 25-year period, you know what? I made an extra 300,000 this year, pay off all my debt, gone. But if you get sick or hurt, or don't do business and your business closes, and you were paying all your debt off aggressively, you have no money in your pocket and you're not making an income. What does that person do? Or on the positive side, the person who was paying the minimum has an extra 100 grand to attract, hire, retain a new doc to help them make more money, right? So I present the scenarios and I let the client choose. One is not right and one is not wrong. It's just, if I present and educate and hold their hand and explain to them, these are your options, what do you want to do? They usually make a good decision.
So for somebody who has debt and has the ability through their income to either put money into an investment bucket or to pay down debt, it seems to me that the analysis that they should be undergoing is, what kind of return would I expect on the investment bucket compared to the interest rate on the debt? And so using your example, if the interest rate on the debt's 5.4%, and in today's market environment, the returns have been in excess of that, even on an after-tax basis, just from not an emotional standpoint, but a purely financial standpoint, in an environment where the equity markets are returning more than the borrowing costs, that works out to your advantage to put money into an investment. Whereas if we go into a period where investment returns are de minimis, which can happen, although people Kylie's age don't know that, then maybe paying off the debt on an accelerated basis makes sense, because your money's actually doing better for you in that regard than it would if you put the money into investment. So, I mean, I take your point about the emotional aspect of it, and some people can handle debt better than others emotionally, but I think from a purely financial standpoint, that's the analysis, right? Is kind of, what's your expected return on the investment versus what's your cost of borrowing, and if the investment return is in excess, then pay the minimum on your debt and divert the other money into an investment. Do I have that right?
Yeah, I think you explained that much better than I have.
Well, you guys had different kind of points there. But so, okay, now just because in case anyone who kind of zoned out just now, I would have 2 years ago, because there's so much jargon and all this craziness. Basically, the idea is when you have loans, you're going to be charged interest until you pay them off in full. So if that's 5%, which can be refinanced, meaning you can go through another company that can get you a lower interest rate, right? So that's also something I didn't know, and you set me up with someone that did that, so I'm at 5% instead of 7 or something like that, right? Mm-hmm. So that was a cool little surprise for me.
That's huge, by the way. I mean,
no, 100%.
2% savings on a education debt is a big difference. I mean, that's a huge get. So thank you, Dan. That's a great thing.
Welcome, but I didn't do anything other than make the connection, right? So Kylie has been a lot more proactive than unfortunately a lot of people are. And no disrespect to you, Michael, attorneys I've seen are the more arrogant professional in general, right? And I let them know that I know that they know everything, right? My father was an attorney, by the way, for almost 40 years. So he knew everything.
This is hitting really close to home. Continue.
All right, lie down. We'll get on the couch now. Call in the therapist and let's go there.
I need to make sure the attorney thinks that it was their idea to do these things. Again, getting back to I'm in sales, but I've met so many, loan refinancing and student loan, and I introduced you to those people because I knew they were going to get the job done. And I look like a hero, even though I really didn't do anything.
But it is, because it's someone, I now trust you because you set me up with this really good deal. And it's a win-win all around. Everyone's happy. But okay, so now just finishing my morons analysis of this. So you helped me refinance my loan. So now I'm at 5%. And what my dad was saying is that, let's say I'm making $100,000 a year, and I could either try to pay off my loans as quickly as possible because that interest rate is just going to be continue accruing, getting larger and larger. However, if I invest 50 grand into my investments and that percentage on my investments growing, that way I can net a little more than if I were to just like panic and be like, okay, I need to get rid of all my loan money and I end up richer.
I agree with everything you said. And I think I don't want this to go by the wayside to your listeners, but yes, you'll get a little bit more, but you have access to money.
Right.
Such a big difference having money that you can use for whatever you want versus I just gave it to some loan company. Right now, I have no money in my pocket, either for an opportunity or an emergency. So I don't want that to go by the wayside either.
Totally. No, that's really helpful. Okay, if you could do a quick summary of 401k versus Roth IRA, when to do it, and just like a little summary and why we need to get into that.
Yeah, so very basic on what the differences are. The 401k is an employer-sponsored retirement plan. So you're working somewhere, they're offering you a retirement plan, and you either can put money in pre-tax, which is a traditional 401k, or a Roth 401k, which is after-tax money. So with the pre-tax, the money comes out of your paycheck without being taxed. So I'm going to use simple numbers. You make $100 a month, you put 5% in your 401k. Right, every month. So your taxable income for that month is not $100, it's $95 because 5 went into the 401k. When you take that money out, it hasn't been taxed yet. So you're going to be taxed when you take it out based on what the tax environment is 20, 30, 40 years from now, right? And which tax bracket you're in 20, 30, 40 years from now. A Roth 401k, you make $100 a month, you get taxed on $100 a month. That $5 goes in after tax. Then 20, 30, 40 years from now, when you take that money out, it's already been taxed. So the growth and the earnings are not taxable, right?
And why would anyone not do the Roth?
So again, it's specific to the client. I don't want to give blanket advice. I never do that. But we have to think about what are you going to be doing or who are you going to be 20, 30 years from now? Traditionally, rank and file employee, I'm going to be in a lower tax bracket when I retire. So if you think you're going to be in a lower tax bracket when you retire, then doing a pre-tax or traditional 401k might make sense because you're going to be making or have lower income when you retire versus when you do now. Now, conversely, if you're entrepreneurial and you're in private practice and you buy real estate and then you get 2 investment real estate properties, and then all of a sudden you retire, you have less business expenses, but your income is much greater than what it was 20, 30, 40 years from now. Maybe putting money into a Roth account where you pay the taxes today and don't pay it later might make sense for you. So it's dependent on the person.
Right.
Some people are not sure. I don't know what I'm going to do tomorrow, Kylie. Right. But some people might do, okay, I'll do half pre-tax, half post-tax. Right.
I see. You can do both.
Yeah.
And then what about how's the IRA different?
Yeah. So IRA is individual retirement account. That might be someone who's self-employed. They used to work for a traditional employer and they left them and went into private practice. Now they have a couple $100,000 sitting in an old 401k. What do I do with that? Also, one thing I should mention, 401k is through work, right? Through your employer. You have very, very limited investment options versus an IRA. You have thousands of options. You can invest in stocks, bonds, mutual fund, all different things. So a lot of clients who have a previous old retirement account from an old employer sitting in some target date fund somewhere that they have to call 1-800 number to find out what's going on with it. A lot of times they'll roll that into an IRA with a financial advisor, and they'll now have so many more options on how they can invest that money versus just that target date fund.
Makes sense. Okay, now just more general. What are some things you notice, especially younger, because that's like more our listeners, people who are out of residency, maybe starting their private practice very early years. What are some like common mistakes you notice that they're making with their money that you wish you're like, I wish you gave to me sooner, or not even sooner, just like, no problem, let's do this instead? Yeah.
So doing it on your own, right? And this isn't just private practice medical professionals. So we're using someone in their 20s or early 30s. I say, who's drafting the agreement with your partner or your employees, right? I'm using my parents' person. They help them do the closing on their house. So they're using an attorney who does real estate closings to draft business agreements. They're not getting specialty. Just like in dentistry, you have peds, you have ortho, you have endo, right? You have prost. You need to have an expert who's specifically working in that field or that type of practice helping you. Going to Google. I can't tell you how many people I meet and they go, oh, I found, and that doesn't mean the person they found is bad, right? But how do typically orthos get new clients or new patients, Kylie?
Google or through other friends.
Yeah, right. Where would they rather get them from?
From their friends, for sure.
Right. The patient's going to be more comfortable to work with you, and they're going to be more likely to keep the appointment.
Yes, that's for sure.
Right. Most of you guys and gals are smarter than I am, right? Be smart. Ask for help. Pride cometh before the fall. Ask your colleagues, ask your friends, ask your parents. Who do you know that can help me with this? Don't try to do it on your own. Don't do Google. Don't do Chat GPT or whatever. A lot of people try to do everything on their own and they miss something. Do you remember that example I gave you about the malpractice coverage?
No.
I had an ortho coming out of training, joining, private practice, potentially the opportunity to, buy that practice over. The malpractice insurance. You want to make sure there's a consent clause. Do you remember this now, or should I just keep going?
No, keep going.
So for example, and by example, I mean this is a real scenario. It's Halloween and you want to be cute and put black and orange rubber bands on the kid versus the tan ones. And then the parents come back and they say, oh, my daughter's upset and embarrassed and they feel sad. And, why did you do this? Their friends are making fun of them. So the malpractice insurance says, just for us to get an attorney and open a file, it's going to cost us thousands of dollars. Look, we're going to give your patient $5,000 or $10,000 to throw away, like a drop check. So drop the suit or drop the claim or the case or whatever. As an orthodontist, I don't want that on my record. I want to have the opportunity to say, no, I'm paying for my insurance. You should fight for me. I don't want this on my record because now my rates are going to go up. Right. And I have a stain on my record. Instead of them saying, no, you can sign the no consent clause. So we're just going to pay off the person complaining to make them go away. So do your homework on everything. It's not just, oh, my best friend does this, or, I'll get the coverage through the AAO and it'll be fine. And I'm not saying it won't be fine, but it's not a box to just check off. Is what I'm saying.
People who want to buy a home or are thinking about buying a home, there's a lot of commentary out today about how home prices are out of reach for people and that the average age of people who are buying homes is now older than it had been for many, many years. And, some people are just kind of giving up and just saying, I'm just going to put money in the stock market and I'll just continue to rent forever and all that. What's your perspective on that? Is home ownership something that people should be aspiring to? Obviously the lifestyle aspect of it, but from a financial perspective, or, how do you counsel your clients on that topic?
I'm going to lead with, this is going to be more of my opinion and based in fact. So my wife and I bought our condo on the Upper East Side 3 years ago. Decent interest rate, not the best interest rate, but now it looks amazing based on what we can get now. And the goal was eventually we're going to, God willing, have a family. We're going to move out to the suburbs. We're going to rent out the apartment. We'll have a rental property. All of this has happened. Right? Except if I didn't have a soon-to-be 2-year-old son, I would not have bought a house in New Jersey the last month or two. Getting back to the investments, everyone and their mother is up. Right? The stock market just keeps going up and up every single day. Right. That's why a lot of new, younger people go, I don't need someone to hold my hand. I don't need someone to financially manage or give me advice. I get 20% every single year. I think you alluded to it earlier, Michael. It's not if, but when there's going to be a correction. Right. I've had thousands of calls with clients. They have great incomes. Right. They're, want to buy a house. And I'm not saying don't buy a house. I just bought one. Right. Because I can't live in 700 square feet with a 2-year-old and my wife for that much longer. There's going to be, I think, some type of correction or bubble pop or whatever you want to call it. People have these big houses and no furniture. Have you heard that saying before? I can't tell you how many people I meet. It doesn't matter if you make $100,000, $500,000, $5 million. People spend every nickel that they have. So what's going to happen is I think people are buying houses they can't afford. Right? I know people are buying houses they can't afford because I meet them. They already bought a house and they can't afford it. And I can't tell them you can't afford that. Right? I'm not going to tell them to sell their house and downgrade. I'm not going to do that to somebody. I think quickly, the reason houses are so expensive is people already locked into 3% mortgage rates or 2.85 mortgage rates. They're not going anywhere. So the older people who are, have considered or considering downsizing, they own their house. It's worth 3, 5, 8 times what they paid for it. Where are they going? They're going to go and buy a house that's way overpriced just because it's in Florida, right? And sell their home. So if you put a gun to my head and said, is now a good time to buy a home where depending on where you want to live, but a lot of people where they want to live is New York, New Jersey, Florida, California, Texas, right? I think it's a horrible time.
I also think to the point about, a correction, people who've been in the market for only a recent period, say 5 to 10 years, they're not experiencing the ups and downs of the market. They're just experiencing the ups to date. And what I would say is periodically you should kind of stress test your financial balance sheet. And if the market were to drop 10 to 15 to 20%, where would you stand? Would that be something that would not affect your day-to-day lifestyle, hopefully, because that's the ideal place to be in. Because then that long-term longevity that we were talking about earlier really is what will cover you, because the market over the long term performs. So, but I think that's something that, especially people who are, in their late 20s, in their early mid 30s, who've been experiencing this rocket ride on their investments, and they should be periodically saying, okay, what happens? Where will I be tomorrow if the market drops 10 to 15%? Is that going to pressure my current lifestyle, my ability to pay my rent, my ability to pay my mortgage, and so forth? I think that's the right way to kind of look at it, not to be pessimistic, but just also to be prepared, because something's going to happen. I can't tell you when, but history, I mean, if you look at the history of the market, it goes up over the long term, but in the short and midterm, it has periods where it will go down. And you have to be, if you're an investor in the market, you have to be prepared for that.
Yeah. And it's not if, but when. And a big part of it is what percent of what you're putting away for yourself is not tied to the market. So a lot of people I meet have most, if not all, their money in the market. If you retired January 2020, you had $5 million and it was all in the retirement investment accounts. May 2020, you had $3.5 million. So getting back to emotional, what do people do other than panic?
They sell. They sell at the bottom.
And Michael, when's the worst time to sell?
At the bottom.
Right. But we're human beings and we're emotional. So what's the hedge against not if, but when the market goes down? So
where can people find you? How can they start working with you?
Yeah. So my name's Daniel Hochler. I'm not going to drop my cell phone on here.
Fair.
But you can email me. You can find me on LinkedIn, Daniel Hochler, Hochler, Daniel_Hochler at FHFG, FrankHowardFrankGary.com. Or you can just bother Kylie and she'll give you my cell phone number. I'll give her permission.
I got the hookup. All right. Well, thank you so much. This was so helpful.
Yeah. Thanks for your time, Dan. Really
My pleasure,
good.
Michael. Nice to meet you. Kylie, thank you for having me. It was fun, by the way. I had fun.
I'm so glad. We had fun
I don't
too.
have a lot of fun anymore. So this is
amazing. Maybe we'll do a part 2 at some point when I actually have the money, where to spend it. That'll be our part 2. All right. Thanks again. Have a good one.
Take care.
Bye. Thanks for listening to Medical Morons. Don't forget to subscribe, rate, and review.